Well, now, I think there's really three factors that are driving the significant increase of interest in infrastructure debt. The first really has to do with the supply. You can barely open a newspaper today that there isn't some government somewhere who hasn't said that infrastructure development is the key to future economic growth. So big programs. In fact, the numbers are so phenomenal, they stop making sense. OECD, EU, they're talking trillions between now and 2020 of fundamental economic infrastructure that needs to be built. But there's a problem. Governments don't have as much money as they did before to finance this. And historically, the banks were financing the long-dated requirements of these transactions, and the banks are pulling back from the longer end. I should stop and say, why long-dated? If you think about it, infrastructure, which is really bricks and mortar, schools and hospitals or roads, merits having long-dated funding because these are not assets that are going to disappear in the next 10 years, and they're stable income over the next 30, so you should have 30-year debt. So the combination on the supply side is making it clear that there are new funding solutions are required. At the same time, for many of you who are in the audience, the question arises as to whether or not sovereigns still represent a low-risk approach to matching your long-dated liabilities. There's lots of comments about sovereigns, but the best, I think, graph I saw one day was, sovereigns, the returns are now sometimes too high and sometimes too low. So obviously there is a greater demand to consider diversification of what your sources of investment assets are on the long-dated side. Always wanting, if you're a life insurance company or a pension fund, to get something that you feel comfortable is going to be stable, but with a sufficient yield to make you comfortable that you can deliver on your fiduciary promises to your stakeholders relative to what kinds of returns you can give them in 25 and 30 years. And the third factor, which combines really the two, is this is not a market that's going away. I mean, it is true that it's a new asset class for us, but here in Rome, we all know that infrastructure, because Roman roads are across Europe, is one of the oldest asset classes in the world. People talk about it being a niche, but when you walk out today and when you get to the airport and when you go to another city, cities don't exist. In fact, everyday life doesn't exist without infrastructure. So it's not really a niche market, it's a global market. Now it happens because of the dynamics that real estate is a global market for you investors to access. I think in the view of Allianz Global Investors, over time, infrastructure should equally be a global asset class because there are many opportunities across Europe, across the world, at different levels of capital structure to get involved in infrastructure. I should say just one comment, which is the team that I'm looking after is infrastructure debt. So we're only looking at the very senior part of the capital structure. There are other conversations about renewable equity or mezzanine debt, but we're really looking for the very, very safe investment grade portion of the capital structure, which means our promise to you is to diversify your risk, but always looking for stable cash flows.
C'è un punto importante che quando si investe bisogna guardare, ci sono diversi punti importanti, quali sono i fattori chiave sostanzialmente da capire, soprattutto quando si approccia a un mondo che si conosce, si inizia a conoscere, si impara a conoscere. Allora quali sono questi fattori? What key considerations should investor focus on when they want to enter this asset class?
Well, I think the first thing I would say is if you agree with the statement that you're looking for a match to your long-dated liabilities, then presumably you agree that you're looking for an additional source of stable cash flows. What that means, particularly in any new market, but particularly in this one, is be very careful of what I would call definition creep. When we talk about infrastructure, we're talking about the stuff you use every day. Not to be overly simplistic, but it's a very easy example. When you get up in the morning, you switch on the lights, that's called electric distribution. That's what we look at. When you go to brush your teeth, presumably, you turn the water on, that's water distribution. We look at that. When you put your kids on a public school bus, that may be part of the public transportation system. If you take the tube, if you go on the road, it could be autostrada, you could be paying, it could be a free road, but the government's paying. That's all what we look at as well. And then when you talk about schools, or hopefully not go to the hospital, but if you had to go to a hospital, those are all the core assets that we're looking at. So think everyday essential services. There were some transactions that have been done in the past that are called hybrids. So somebody argued that service stations along the toll road were essential. Well, they're essential unless you're shopping for the best priced gas and you decide to get off at the exit. So we would say that anywhere we have a significant level of commercial risk or competition, that's not really what we're thinking of. So definition creep, think core infrastructure, at least to begin with. Over time, when you start to have more diversified opportunities, maybe you will say, I want to take riskier infrastructure or high-yield infrastructure or emerging market infrastructure. But to start, we would say, stick with the core essential stuff where you get to understand the asset class. When we say core essential, there are also some very clear characteristics. You want things that are quasi-monopolistic. Let's see, show of hands, how many of you have gotten off a toll road to take the free road, even though you knew it would take more time? Nobody? Usually a lot of hands go up on this one, right? The point really is simply that when you look at, I've been on a toll road before where the GPS kept saying, at the next round point, turn left. It's like, the next round point, I'm on a motor highway with a toll. But that's because there was a free road next to it. Now, of course, the good news is it was August in France, and by virtue of having paid some tolls, I had no traffic. The bad news is, if I had been the person who financed that toll road, I would be very concerned about the revenues. So when we do the analysis, we're very focused on not just the essentiality of the asset, but to ensure that it's quasi-monopolistic. And that figures into the stability of the cash flows. It also is important that you look at the low elasticity of demand. If you want stability, you can't take transactions that go up and down. The most obvious might be an airport. There are plenty of regional airports now that have become hubs for low-cost carriers. Well, that's great, but if the low-cost carrier disappears, you have a very good chance of finding that the airport revenues have disappeared as well. So we think about destination airports, places people go no matter what happens, Rome, for instance. So it's very important to think about what the elasticity of demand is, and we focus only on low elasticity. And the last, which I think people are beginning to understand all the more, is the expertise. So concept simple, build a road and put a car on it. What's so complicated about that? But now we're talking about build a road and put a car on it and feel comfortable that there will be enough cars to pay your debt service in 28 years. Now it starts to get a little bit more complex. So what's important is not only that your asset manager has the experience in doing all this analysis of how essential the asset is, but that they understand what the funding structure needs to look at, like for the 30 years. Nobody knows what's going to happen in 20 years or 25 years, but everybody knows something's going to happen. You know that if it's only because you've had to detour your route because there was a water main. Or think of this, after 9/11, unfortunately, it was very difficult to get any kind of insurance if you're in the aeronautic industry. So somebody who was managing a piece of debt needed to be able to make waivers over the insurance for the 1 or 2 years where you're waiting to get it. So these are just examples of the fact that not only do you want to put the right triggers and covenants into these structures, but you also need the expertise to manage and monitor it over time. You know that with real assets, something will happen. You just want to make sure that your asset manager is there when it does happen, or hopefully there before. And so they've adjusted and remedied the issue before it becomes something that is going to have an impact on your cash flows or the rating of your debt.